Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Today I was scrolling through the comment section like I normally do. Reading your guys' comments, one of the questions is, got a question regarding this. If there are so many buying opportunities, wouldn't you be running out of cash flow? How do you balance the amount you put in against the frequency which will incur commissions per trade? Also, have you had a situation where most of your purchases have not increased in price and you are now out of cash? So have you had a situation where most of your purchases have not increased in price? Yeah. So the way that I played this in my strategy was when the ratios were cheap and we had technical analysis and we had those bottoms, like in Bannerman, SM Energy and all that, I really put a lot of money in it at that time. I overweighted it. And that was where I kind of made my, I call it core positions. That's where I kind of beefed them up quite a bit. It's gone higher since then, and I've cost averaged into some of the companies. In those, I'm using my income coming on in, and what I do is I usually have a chunk of money that I make, and let's say I want to deploy like $1,000. I may be buying some of these in increments of like $100 or $200. So I may have 10 purchase points, I may have whatever. And the way that I choose this or manage it is I have a money that I have set aside for emergencies. Think of it as like 3, 6, 7, 8, 10 months of cash, right? And it depends on how much you have saved up. Because I also have a health savings account with a bunch of money in it. I've got other like physical metals that I could hit. I have a lot of other stuff everywhere. I can sell stock and redeem it and get money from there as well. So I have access to a lot of money if that were to, if something bad were to happen, like an emergency, or if I had to immediately pay off my house. I have all these, this resource that I have in savings to do that if I had to, and I can raise cash quite dramatically if something were to happen. So I always have that safety. I'm not putting everything in the market. So the goal when you have money is to not really have to take it out of the market. I view this money that goes into the market like it's going to be in there for 5-10 year period, at least. So I'm looking at the cash that comes in gets directed to the best opportunities that I have. And if that money runs out, that runs out then. I do not sit on my hands and wait for a crash. I cost average into where I think the best opportunities are at that time that have good chart patterns, that are in sectors that I like, and that have patterns that look like they're going to break to the upside. If those exist, I deploy money until I don't have any left. And I don't mean I don't have any left to deploy at that time. So I'm not sitting on a bunch of cash. I'm putting it to work in companies that are spread out in my favorite sectors and my favorite companies that I think the juice is worth the squeeze. So it says, how do you balance the amount you put in against the frequency which will incur commissions? So I don't pay commissions per trade. Some of the companies do have fees. Some of the African companies, I think when I bought Bannerman, it did not have any fees at that time. So I bought in a lot at that time when there was no fees, and then I've purchased a couple times with it, and they were larger purchases. So I had to time those purchases a little bit better. I'm not just randomly adding money to all my companies. I'm not doing that. And sometimes I may put larger amounts in certain companies at certain times if I think it's a really good opportunity and the chart looks really good. So I might put in a couple grand or something like that in one shot. And my initial position might be 10, 20 grand maybe. It depends on the size of your portfolio. If your portfolio is, hundreds of thousands or millions of dollars, you're going to be putting in tens of thousands of dollars in each position as a core position in the beginning. You do not want to chase price. Chasing price is not going to get you anywhere. You have to chase value. You got to find the value. You got to get the setup. You got to let the stars kind of let themselves align themselves, and that's when you go big or bigger. So I do have, I do run out of cash sometimes to deploy that is used for the deployment of investing. I never dip into a certain amount of cash that I have sitting on the sidelines. Now, how much cash should I have on the sidelines? That's highly dependent on your expenses, on your living situation, on a whole bunch of different things. And, I have access to cash all over the place. That's the way I set this up. So I have a HSA with tens of thousands of dollars in it, let's say. All right. And then I've got cash that I've got, let's say, maybe I keep like 20 grand or something like that. And I don't even know what that is in relationship to my expenses. I have pretty low expenses. And then I may have a whole bunch of physical metals and other stuff. So if something were to go wrong or if something were to happen, I could have money to kind of work my way through. Or if I have a health issue or health issues within the family, I can hit that. Obviously, I have health insurance. I have all these different insurances to protect me from any catastrophic problem. So, and obviously, I'm kind of getting a little bit off, but you got to have all that in place to protect yourself if something bad were to happen. And it's super dry here, guys. That's why I'm drinking so much water. It's like, my voice is getting super dry. So if there's buying opportunities, that's when I take them. They got to be there. So that's, and I don't have commissions per trade. They're all free. My brokerage, I've got Charles Schwab, Fidelity, and I think those two are the main ones. There might be one other one that I have too, TD Ameritrade, I think. Going down here, looking at some of the other stuff, it says, call me Chicken Little, but I can't help but feel that the markets could pull all prices lower soon. And that your feeling is probably right. It does look like a little bit of a potential pullback, but the way that I view it, guys, since charts are not perfect and since people are kind of crazy, and I totally agree with that sentiment there, but I just stay in it and ride it. I've tried doing some timing last bull market and didn't work out the way I wanted to. And remember, guys, I didn't have the same amount of knowledge back then as I do today either. And a lot of the information isn't nearly as freely obtained as back then. But I'm going to ride through it. And if I see 30, 40% pullback, so be it. I'm going to keep adding in into my favorite sectors. And at some point when the big move comes, it's going to be very large. And it usually happens more in the middle to end of the expansion phase of real estate, not necessarily in the beginning. And we're in the beginning. So this money's got to get in the system. It's got to start flowing through. We have money from stimulus that has come into the system. It's flowing through. So I do think that we're going to have inflation for a good few years. And I think it's going to be maintained as well with the expansionary phase of real estate at a higher level. So I think the money's out there. It says pretty dismal day in general for uranium stocks, and yet general markets up. What gives? Uranium's weak. It looks like we're in a consolidation pullback. If you look at my technical analysis updates, I keep saying, hey, look, we could potentially pull back. I'm not seeing buyers step in here yet. So, and again, I'm not selling anything. I'm just going to hold on. I'm going to repeat that self over and over to everybody, but it doesn't look strong. The charts do not look strong to me. I don't see a big move higher. And I know some people, you don't use RSI, you don't use MACD, and those are really reliable indicators. They're not reliable indicators. I've used them before. They don't work. Everyone who uses that, they just throw them away if you're a seasoned trader. Like, you don't use that stuff. I don't. That's what I found. I found that it doesn't give me any value. It's not reliable. It's not anything. What I'm looking at is before that. That's a lagging indicator. It'd be like driving a race car by using your rearview mirror. It doesn't work very well. What you're looking for is the interaction between the buyers and the sellers and what footprints they're leaving each day. And what we're seeing is we're looking for trends. Is it trending up, or is it breaking the downtrends? Or we're looking for resistance levels. If something comes up and it hits its head on something, you know that there's resistance up there. It's selling pressure, selling pressure, selling pressure. It's holding this thing down. And if every time we hit a level, you see a massive sell order hit, it's like, boom, it just hits it back lower. And then it comes back up and boom, it hits it back lower. It's like, well, there's a lot of sellers up here. It's probably going to head lower if that seller becomes impatient and just says, screw it, I'm going to sell everything. So That's what I look for in the charts, and RSI isn't going to catch that, and neither is an MACD. And those are just some tools that people use, and I just look at the candlesticks and the interactions between the buyers and the sellers and what they're leaving with those candlesticks. So that's kind of how I use that there. It says Andy has value some years forward. Listen carefully. Just keep in mind, guys, that a lot of this stuff is a long-term investment. Looking at the short term and being, if you're chasing things that are already up, and here, I'll pull up a couple of things here, and this is what I would not do. If I'm an investor, I would not do this. And for instance, and whenever you see kind of a large move higher, I'll pull something up here. Something like a lithium. Lithium's had a pretty big move, and lithium right here, if you look, has pulled up quite dramatically, and it's been quite straight up. And I know a lot of people are like, oh, this looks great, and they get this recency bias of this is going to continue, and it's like, I would not be a buyer here. When I see that there, I see a missed opportunity. That's what I see. If you're looking at it from this perspective here, I would wait for a pullback, wait for it to pull back, and then if it kind of bottoms out and starts looking good, then I would add money into it. But I wouldn't just be dive bombing in here, way up here. It's had such a good move, and the move was like $40 to $82. It's a 100% increase in an ETF over a little over a year time span. So your risk reward gets a little bit skewed, and we could be at a like, if you look at this here, you could do like a first wave, a third wave, and a fifth wave, and we're probably going to go into consolidation period. But the consolidation periods could go sideways. Sometimes we see that in REMX, which is also sharing that, may have a similar chart setup, where we come up and we kind of go into this corner here, and then we break to the downside. We're going to make a lower high here, and we could potentially head back. And we do have a bearish engulfing pattern, which means we could head lower. We could see a pullback in, back here or something, where we pull back for a little bit. God, look at RAREF was up 23%. Wow. And whenever you see things like really up there, I just don't go into it. And when people give me like suggestions and whatnot, and they're like, hey, why don't you look at this? They usually give me ones that like moonshot it already. And it's like, I'm not going into that. I never, ever chase. Never chase. Now, I may add in at wrong times because I'm trying my best to catch a bottom, and that's all you can do. I mean, that's all you can do is try your best to get something that's down, that's bottoming out, that's about to take off, and that's all you can do. And sometimes you don't time it right. It happens to everybody. It happens to me. It happens to everyone. And a lot of the times I'm early because I know the value's good. I know the sector's good, and I add in. Now, where I add bigger amounts are at the tips of things. And if I mess up on adding something in, I may add in later at a lower price if the chart pattern looks better and better as it's consolidating. Can you please list the tickers for the companies you talk about in the future? Are you talking like oil and natural gas? And guys, I may open up a web page where I can post all this stuff, but it's going to be, it may cost a little bit of money. And I may say that because it is hard to read some of these perhaps. But, and then you can see everything. You can see a lot of my picks. You can see, I can post charts. I can post all sorts of stuff, and you guys can see it all there. It makes everything very easy to follow. So that may be an option. Put in the comment section if that's what you want. I saw some people put some comments if they want that. So I might have to go in and do that. Should have put my money into CPE, money into CPG. Guys, in all honesty, you shouldn't be trying to time this stuff. That's not how you make money. You make money by adding money in and then just sitting on it. Like that's what I've found. And what you're going to find with people who have a lot of money in the market is that's what they do. They don't jump in and out, in and out, in and out, in and out, trying to time this stuff. I tried doing that last time. It didn't work. New investors do that. As you become more seasoned, you look at longer time frames, you go for larger moves, and you don't trade in and out. That's the way that I view it, though. If you're a trader, then you know what? I don't know. That's just me. I don't try to do that. Let's get if you guys see these big posts where if they have like a WhatsApp or anything, it's not me. Even if they put my name, it's not me. I don't have a WhatsApp. It's not me doing it. It's all whatever there. So someone says Gareth Soloway is short oil at this time. I was surprised to hear on the program yesterday. He is, however, long metals finally puzzling to me. Oil could pull back, and that guy's a very short-term trader. And oil, what he's doing is he's hoping that it comes back up and hits that resistance line and it kind of bounces back down. He may think that we're in a correction phase, and we very well could be. The overall market looks a little bit weak. We could see rates pull back a little bit. So when these guys talk that you're listening to, and they say that they're short something, they may be short for like a week. They may make like 8 or 10% and then they get out. I'm not in it for that. I'm in it for the long term. I'm in it for the big moves. So my viewpoint and what I'm showing and teaching here is very different than, say, some of these guys that you're listening to on YouTube. I'm not a trader. Even though I'm doing these daily technical analysis updates, it's giving you guys a heads up of what's potentially coming, in my opinion. But really, I'm just buying it and holding on for the entire bull market. So that's kind of my take on it. I'm finding value. That's what I'm doing. Hence the name of the channel. I'm finding value. I'm buying it. I'm making an investment. I'm saying that thesis is going to work for a good 5 to 10 years. We're going to ride this thing higher for many multiples higher. And then eventually it's cyclical in nature and you want to swap to something else at the end of that move. So that's my viewpoint, guys. If you guys have any other questions, put it in the comment section below. Love to hear your guys' opinion. Thank you for listening. Give me a thumbs up if you like the content. Subscribe to the channel if you haven't. And thank you. This is Finding Value.